the market narrative in the last couple of weeks has changed. People are beginning to be a little bit concerned about the pace of the recovery that's coming out of China. There appears to be a moderation if you look at some of the official indicators. Would you say that that also is supportive of your own outlook for China and how growth is going to pan out in the second half of the year?
Indeed, we see that high-frequency indicators suggesting a slowdown, not in China, in many places in the world. You see that, when you look at the earning calls of companies. I think this weakness will be with us in the second half of the year, and next year it will continue. We are expecting a kind of a recovery next year in the global economy, but that's going to be a tepid one.
Yeah.
The important point to remember is the following. This year, global economy will deliver growth lower than what we saw in 2010s on average. This is true for advanced economies, and it's true for emerging market developing economies. One can say, the glass is half full. Global economy has been resilient, but at the same time, when you look at the big picture, how weak the growth is, we should be concerned.
What is the region you are most concerned about, though?
I think that other than South Asia and East Asia Pacific, these two regions have been delivering strong growth numbers thanks to China's performance as well as India's performance. But when you look at Sub-Saharan Africa, this region has to deliver much higher growth than what is delivering around 3%. You have very large challenges in terms of development, in terms of poverty, and you need to have growth numbers close to 5%, and you are struggling around 3%.
Yeah, and it's not just about growth, it's also about financing costs as well. We started off talking about higher interest rate costs around the rest of the world. Clearly, the Fed in the US has been leading the path on that. How much of a problem are higher US interest rates for the rest of the world and specifically for lower income countries?
The global economy has an inflation problem, and that problem requires central banks to be very active. And the US Fed has been exactly doing that. And those higher interest rates have consequences. When you look at the kind of the debt levels around the world, we have record high debt levels. When you have weak growth, high interest rates, record high debt levels, of course, you will have challenges in terms of finding policy space to stimulate activity and get growth going.
One of the statistics that stood out to me from the report, you say that 14 out of 28 lower income countries, so that's half of the countries in your list, are assessed as being in debt distress or high risk of debt distress. Are we going to see more countries defaulting?
It won't be a big surprise when you have, such weak growth rates and the elevated interest rates. Inflation has been coming down, but still, when we look at the core inflation, in many countries, core inflation is high, quite persistent. That puts central banks in a difficult position in terms of keeping interest rates high or pushing interest rates higher. And low-income countries, they have much larger interest payments because of these tighter financial conditions. And I think that it won't be a surprise down the road. We see more countries falling into debt distress.